One of the biggest questions we get every day when talking with home buyers is what down payment they're going to need in order to purchase a home. And the biggest surprise to me is how many people still believe that you need 20% down to buy a home. And guys, that's just simply not true. There are so many loan programs available today that offer no down payment, low down payment, and flexible down payment options for home buyers, whether it's your first time or your 21st time. And so what I'd like to do today is walk you through more information about the down payment process, how much it's going to cost you to purchase a home, how much you're going to need to put down, what are some of the myths surrounding down payments, and more information like that. So if you're thinking about buying a home and the down payment feels like a huge hurdle to you, then definitely stay tuned for the rest of the video. All right, so let's jump in. First of all, what we need to talk about is what is a down payment, right? Like, what is a down payment? Why do I have to pay one? So a down payment is simply a percentage of money that you put down on your home when you go to purchase it. It is a skin in the game, if you will. It shows the lender that you are invested in your home purchase, that they're not just financing you, and you don't have any skin in the game. And so that is why most loan programs are going to require you to have some form of down payment. Now, down payment is based on percentages, like I just said. So to make the math easy, if you were going to purchase a $100,000 home and you needed to put 3% down, which is the lowest down payment on a conventional loan for a first-time home buyer, and we'll talk more about all this, then that down payment would be $3,000. Each loan program has a different percentage that it's requiring you to put down and a different percentage that you have to meet. But not all loan programs require a down payment. So when it comes to certain loan programs, they may, like USDA, for instance, or VA, then they're not going to have any type of down payment requirement for those particular loans. And so we're going to talk about all of that in today's video. So let's talk about how much you actually need to put down based on the different loan programs. And I know for a lot of you, this is where things can kind of get scary. Your heart starts beating, you get this feeling, this lump in your chest, because you know that saving up for a down payment is probably the number one reason why you haven't purchased a home yet, or that's keeping you from purchasing a home in the future. And so let me help you figure this out by helping you understand that it might be less than you think as far as how much you need to put down on a home. And so you've basically got 4 major loan programs, and I've got a link to a playlist right here where I go over each of these programs in detail. But you've got 4 major loan programs. You've got FHA, VA, USDA, and conventional. Those are going to be the primary loan programs we're going to discuss in today's video, and as far as what down payments are going to be required. So let's just start with FHA. This is probably the easiest one other than the VA to get qualified for. So with an FHA loan, they're going to be very flexible. They're going to accept credit scores down to 550 with 10% down. So a $100,000 house, you would need $10,000 to put down. 580 goes to 3.5% down, so $3,500 for a $100,000 house. $200,000 house, $7,000, right? That's FHA. So 3.5% down if you have 580 or higher, 10% down if you have 550 to 579, right? So those are the 2 options that you're going to have when working with an FHA loan, not 20% down. And notice you don't have to have great credit either. So really, really great option for those of you who may have had past credit issues, lower scores, bankruptcies, foreclosures, things like that. FHA tends to be a great program. Next, we have USDA. Now, USDA is amazing because it's no down payment. It's 100% financing. So when you go to purchase a home, you don't have to put a down payment down. You don't have to put any money down as far as the down payment goes. There are still closing costs, but if you've watched any of my videos, I'll link to it here, about the USDA program, you'll see that you can even get the seller to pay for your closing costs on USDA, or maybe even roll it into the loan if it appraises for more than what you're purchasing it for. So USDA is going to be no down payment, 0% down. Now, my company is based in Louisiana. Louisiana is an amazing market for the rural development loan, which is what the USDA loan is. Almost all areas are going to qualify. If you live outside of any of the major cities, in those suburbs, outside of those city limits, are pretty much wide open for using the USDA loan. And I'm talking about places like Gonzales and Prairieville and Denham Springs and Mandeville and Covington, Sulphur, Moss Bluff, Westlake. all of those different major suburbs of all of the different cities in Louisiana are going to qualify for that zero down program. It's one of the reasons why we talk about it so much, because we like to do them. Louisiana is a fantastic place that allows you to do them. The USDA loan is going to require you to have a 640 credit score, but on average, many of our lenders, at least a few, will go down to a 580 if you can pass some more stringent credit requirements. And I do have a video on what that looks like called manual underwriting. And so there are even flexibilities within that program. Now, the next program, it's another zero down program, and it's one of my favorites. It's the VA loan, right? So if you are a veteran, if you're active duty or a guardsman, and let's say you're in the Guard and you've been in the Guard for 6 years, or you've been deployed for at least 90 days of active service, basically 90 days of wartime service, or if you are a veteran, then you're going to most likely qualify for this loan program. It's extremely flexible whenever it comes to credit requirements. We have lenders that will go down to a credit score of 500 on the VA loan, and it's no down payment. And not only is it no down payment, it's also no PMI. And so you get this really amazing mortgage with this really low payment with no down payment. Now, again, like USDA, there are closing costs involved, but also like USDA, you can have the seller cover those closing costs in the deal, and we do see that most of the time with the loans that we're working on. So the VA loan, another great zero down payment program. Finally, let's talk about conventional. Conventional loans are the ones that are thought to be this 20% down needed, I've got to have 20% down or I can't buy a home type of situation, and that's actually not true. So if you're a first-time home buyer, or if you're a low-income home buyer, and that's judged as, are you below the median at or below the median income for your area, then you can qualify for one of two different programs. You can either just use a traditional 3% down first-time home buyer conventional loan, or if you're a low or moderate income, then you can use what's called Freddie Mac Home Possible or Fannie Mae Home Ready. And all three of these give you the option to purchase a home with just 3% down. Now, the caveat with conventional loans is that even though they have a published minimum credit score required of 620, it is very difficult to see approvals through their automated underwriting system, and they don't do manual underwrites typically with scores under 680. Now, 660 possibly, but again, very difficult if your score is under 680 to go there. So if you're someone that's got great credit, you can even do a conventional loan with not 20% down, 3% down, if you're a first-time home buyer or if you're low to moderate income. If you're neither of those things, then conventional says the minimum down payment is 5% down. So not 20% still like most people believe, but only 5. So these are the 4 major loan programs and their down payment requirements. And at this point, a lot of people are like, well, wow, I didn't know that, right? Because you're thinking, I have to have this huge down payment, but none of these programs have a huge down payment requirement. It's just that there's a lot of chat and a lot of babble and a lot of discussion in our space from quote unquote financial gurus who say that you should wait to save a big down payment or do all these different things. But as you can see, from just a pure facts standpoint, you don't need some huge down payment in order to be able to purchase a home. So a lot of times we're asked like, well, why do I even have to do this? And I kind of alluded to it in the beginning. The reason you're going to need a down payment is so that you can prove that you've got some skin in the game. That's why most of these loan programs, well, it's really 50-50, right? Some require it and some don't. And the deal behind it is that the reason we're able to offer low and no down payment programs, even though you're not putting that much skin in the game, is because those loans are insured and backed by the departments that issue those loans. So FHA is the Department of Housing and Urban Development's loan program. So they insure those loans. They don't finance them, but what they say is that if you purchase the home and later default, they'll reimburse the bank a certain percentage of money in order to cover that foreclosure. It's the same with USDA. It's the same with FHA. The only loan program that typically doesn't offer this type of insurance to the bank is the conventional loan program. And that's why you're going to see on conventional that you need to have much higher credit, because for whatever, algorithms that they've determined, people with higher credit scores are less likely to default on their homes, or less likely to default on their mortgage, especially when they've had to come up with a down payment. The higher the better, right? So that's how they kind of think about those things whenever determining, like, why do we even have to do this down payment? Why can't I just get a loan, if you've got good credit and you go buy a car, like I don't usually have to put a down payment there. So those are the reasons why. Buying a house, by the way, very different than financing a car. So the next logical question that we get asked is, should I save for a larger down payment? So even though these loan programs don't require me to have some type of large down payment, should I save for a larger down payment, right? Some guy I heard on the internet said you should only buy a house if you have 20% down and only do it at 15 years. And what's with that? So let's just discuss some of the pros and cons with putting down a smaller down payment versus putting down a larger down payment. So the biggest reason why putting a smaller down payment is better than waiting to save up a larger down payment is because it gets you in the home faster. And study after studies have shown that the housing market continues to increase over time. And we're not just talking about like over the last 5 years. We're talking about traditionally over the last like 50 years, with that little gap in between where we had the whole world blow up in 2008, 2009. If you wait to save up for a larger down payment, it's negating its effect because the cost of the home becomes more expensive, the interest rates are rising, your payment's getting more expensive, so you can buy less house, versus if you had gotten into the house with the lower down payment, you've been making monthly payments on that home this whole time. And so now you have what's called equity in your home. You're building equity, you're building wealth for yourself. Every month that you write a rent check, that's money that's out the window. You don't get that back. There's no equity built into that. You're not owning anything. You're paying someone else's mortgage, and it's not the best financial decision if you're committed to purchasing a home. When it comes to larger down payments can be great, right? The pro of a larger down payment is that it's going to make your monthly payment lower, but not as low as you think it would. $50 maybe, $20 maybe. It's going to make it easier for you to qualify for a home loan. For instance, USDA can be very tricky to get qualified for, even though they are flexible, they have all these different requirements. But if you have 3.5% down, you can go FHA and they're much more forgiving, right? Same scenario on conventional. If you're like a 660, well, if you're only putting 3 or 5% down, an approval on that's going to be pretty tough. But if you're putting 20% down, an approval becomes more likely. And when you put 20% down, you also don't have that private mortgage insurance, that insurance that says, hey, we're going to refund the bank if this person defaults on this loan. That's another thing to consider. And while that cost may be $100, $125, $150 a month, you always have to weigh these things and determine, is that little extra cost enough to discourage me to keep wasting $1,500 a month in rent or $1,200 a month in rent, whatever that is. So always be on the lookout for those things. So yes, there's pros to the larger down payment, but if saving a larger down payment means waiting another year, another 2 years, another 3 years, another 5 years, it's probably not worth it to do it. It's probably better to utilize a low down payment program now and then start building equity later. Let's talk about what type of down payment sources are acceptable. Now, this is a big one, okay? We talk to a lot of people and I'm like, hey, you got a down payment? Yes, I got a down payment. Where's it at? It's in my savings account. That's great. Other times we talk to people and we ask them where it's at and they say, it's in cash in a shoebox in my closet or wherever. Listen, when it comes to down payments, cash is not your friend. So if you're thinking about buying a home and your down payment is sitting in cash in your house, it needs to be put into an account and it's going to have to be seasoned. Any money that's in your account will have to be seasoned for at least 60 days before it could be used for your home loan. So keep that in mind. If your money's sitting in cash, you're at least 60 days out now from being able to start this process of buying a home. Don't just use cash. Cash cannot be sourced. And because of the federal regulations involved in purchasing a home in the United States, cash is no good, right? It's not any good. Unless you sold something and you've got this bill of sale, and even then it gets really complicated. But the acceptable sources where your down payment can come from are bank accounts, checking, savings, money market, CDs, any of those type of accounts. They're going to be fair game when it comes to purchasing a home and using those accounts for your down payment. The other one that a lot of people don't think about is your 401k. Now, I know that a lot of people don't like to pull from their 401k because it's their retirement in order to purchase a home, but many 401ks have a loan feature built into the program where you can withdraw the money via a loan, and it's penalty free typically. You repay the loan back to yourself with interest over time. So that can be a very workable scenario for a lot of people, or some people just want to do the withdrawal, pay the penalty, and be done with it. But either way, those are options and opportunities for you to use those funds in order to purchase a home. Next is going to be gift funds. So if you've got a family member, a relative, an employer, or someone like that, as long as they're not involved in the transaction itself, they're not your realtor or somebody like that, they can actually, with a lot of these programs, give you gift funds, so they can gift you the money. Now, emphasis on the word gift. It cannot be a loan. There cannot be an expectation of repayment. And whoever gives you the gift has to sign a letter stating that. There's a pre-formatted letter that we provide, and it says, hey, this is a gift. I don't expect them to pay it back. Here's how much I'm giving them. All of that stuff. So the other thing is that they've got to be willing to let us get in their business a little bit. Unless it's a conventional loan, the other loan programs require us to look at the bank statements of the person giving the gift to make sure that they have the funds available. And so sometimes they're a little iffy about that. So if you're planning on getting a gift from your parents or someone like that, it's really good to go ahead and make sure that they're aware of everything that's going to be required of them up front, because it could totally derail the entire mortgage process, and then it just kind of creates some frustration for you as far as not being able to get the loan or making them upset because they don't want to do these types of things. That's where your down payment can come from. Retirement accounts, 401ks, any type of bank account, gift funds. Can you sell things? Yes. And use those funds? Yes. But we have to get a value on the item you sold, and it can't exceed that value. And it's just, it can be a really complicated process. Cash is just a non-starter, no-go zone on the cash. So I hope that you found this video enjoyable, and I also hope that you realize that maybe you don't need quite the size of a down payment that you thought you were going to need, and maybe you're just a little closer to buying a home than you felt. If there's anything we can do to help you learn about this process or get you in a position where you feel comfortable, there's a link somewhere around this video. If you're watching on YouTube, it's up there. And it's going to say, see what you qualify for. We would love for an opportunity to show you what you can qualify for. If you're in Louisiana and soon to be Texas, then we'll be able to help you with these types of things. So I'm Channing. Thanks for watching the video. I'll see you next time.